We think 2026 is a year where fundamentals will remain rock solid. We expect banks to continue in the same trajectory as the one we had during the past year and the ones before. The past year, 2025, has been a year rich of events, some of which have been actually mildly reflected in markets. I think in the end, for the amount of things that have happened during the year, market volatility has been plentiful in a couple of occasions, but overall quite low in the end. In financials, the highlight and what we thought would happen from a fundamental standpoint has actually remained very, very strong. We approached the year with the strongest balance sheets ever, and combined with the most solid P&L metrics that we have witnessed over the last 15 years. So the performance overall in our funds has been strong, and ultimately the worries that we have looking into next year may only come from the top-down perspective of the market, because we expect the fundamental side of things to remain very, very stable and very, very strong. Overall, looking forward, we approach 2026 in a situation where the spread compression has reflected the improved performance in fundamentals, and so that has happened and is welcome, and it's also justified fundamentally. There has been a lot of supply in financials for 2025, and we expect a similar number next year, but a touch lower, especially in European senior bonds. So the technical probably doesn't shift to a positive and remains neutral from that perspective. And valuations are still attractive. Net risk reward in financial capital remains very, very interesting. We had plenty of things that have happened during 2025. I mentioned one, tariffs. We still have uncertainty around the implementation of these tariffs and whether the Supreme Court will strike them down. And overall, I think we still have question marks around the fiscal posture of some countries in the world, where some imbalances do remain and overall can create some volatility. For next year, we expect a very large amount of supply in the corporate bond market, driven by AI spending. Overall, this will lead to some negative technical in the corporate IG market, and we expect financials to be relatively insulated from this phenomena, but not totally immune, because at the end of the day, financials will, as usual, in senior bonds, have large programs that need to be funded each year. Now, next year, as I said before, the programs are going to be a touch smaller than they were in the previous, and they are totally manageable from an absolute perspective. We think 2026 is a year where fundamentals will remain rock solid. We expect banks to continue in the same trajectory as the one we had during the past year and the ones before. Secondly, we expect the market technical to remain neutral to positive on the banking side of things. However, we expect the market one to deteriorate a touch, driven by these large issuance programs on the technology side of things. And thirdly, we think valuations are still attractive from a risk-reward perspective, especially in financials. However, in absolute terms, spreads are at the tighter end of things, and so our positioning in general is a touch less aggressive than it has been looking a year back, but ultimately remains long because we think fundamentals and total returns are actually going to look good into next year.